Are you looking to steer clear of common investing pitfalls and gain valuable insights from one of the greatest investors of our time? Get ready to delve into the 10 mistakes that the average investor often makes, straight from the teachings of the legendary Warren Buffett. From the perils of impatience to the dangers of following the crowd, these invaluable lessons will empower you to navigate the world of investing with greater wisdom, boosting your odds of achieving long-term success. Here are the 10 mistakes. Mistake 1. Lack of patience. One mistake many investors make is lacking patience and seeking quick profits. They may get easily swayed by short-term market fluctuations and make impulsive decisions. For example, imagine an investor who buys shares of a company and sells them within a few weeks simply because the stock price didn't immediately rise. This impatience prevents them from allowing their investments to grow steadily over time. Buffett often advises investors to have a long-term perspective, focusing on the underlying value of the investments rather than short-term price movements. An example of this is seen during the cryptocurrency boom in 2017, where numerous investors jumped into the market without a clear understanding of the technology or the underlying value of the coins. When prices eventually corrected in the following years, those who had not exercised patience faced significant losses. Mistake 2. Following the crowd. Investors often fall into the trap of following the crowd and investing in popular trends without doing thorough research. For instance, during the housing market bubble that led to the 2008 financial crisis, many investors followed the crowd and invested heavily in real estate, assuming that prices would keep rising indefinitely. However, when the bubble burst, those investors faced substantial losses as housing prices plummeted. Buffett suggests that investors should think independently and base their decisions on a company's underlying fundamentals rather than popular sentiment. An example of this is seen during the dot-com bubble of the late 1990s, where many investors poured their money into internet companies solely because they were the hot new trend. However, when the bubble burst, numerous investors faced significant losses because they hadn't evaluated the fundamental value of these companies. Mistake 3. Trying to time the market. Attempting to predict short-term market movements is a challenging task. Many investors make the mistake of trying to time the market by buying stocks at their lowest point and selling at their peak. However, consistently timing the market accurately is nearly impossible. For example, an investor may sell their stocks during a market dip, hoping to buy them back at an even lower price, but the market could quickly rebound, causing them to miss out on potential gains. Buffett advises investors to focus on the long-term prospects of companies rather than trying to time short-term market movements. An example of this is seen in the difficulty of accurately predicting market crashes. Investors may attempt to sell all their stocks just before a crash, hoping to buy back at lower prices. However, accurately predicting the timing of such events is extremely difficult, and if the market doesn't crash as anticipated, the investor may miss out on potential gains while waiting on the sidelines. Mistake 4. Overcomplicating investments. Investors sometimes complicate their investment strategies with complex financial products or strategies they don't fully understand. This can lead to poor decision-making. For instance, investing in highly leveraged derivatives without a deep understanding of their risks can expose an investor to significant losses. Buffett recommends investing in businesses and industries that are within one's circle of competence, where they have a clear understanding of the company's operations and its competitive advantages. An example of this is seen in the complexity of financial products during the 2008 financial crisis. Many investors were enticed by the seemingly high returns of complex financial products such as collateralized debt obligations, CDOs, without fully understanding the underlying risks. When the housing market collapsed, these complex investments suffered significant losses, causing widespread financial turmoil. Mistake 5. Failing to do proper research. Insufficient research is a common mistake among average investors. Warren Buffett emphasizes the importance of thorough analysis before investing. For example, an investor might buy shares of a company without fully understanding its competitive position, growth prospects, or financial health. This lack of research can lead to investing in fundamentally weak companies. Buffett encourages investors to study company financials, industry trends, and competitive dynamics to make informed investment decisions. An example of this is seen in the failed initial public offering, IPO, of WeWork in 2019. Many investors had not thoroughly researched the company and blindly invested based on its fast-paced growth narrative. As more information about its financial struggles and corporate governance issues surfaced, investors faced significant losses. If you're still captivated by this video and hungry for more knowledge, we have a special recommendation for you. Dive into our ebooks, Millionaire Secrets, and Master Your Money. These essential resources are a must-have for any serious investor striving for financial success. You can find the link in the description below. Don't miss out on the opportunity to empower your investment journey with these valuable resources. Now let's get back to the last 5 mistakes most investors make. Mistake 6. Ignoring the value of cash. Maintaining a cash reserve is often overlooked by investors. Having liquidity allows investors to take advantage of attractive opportunities during market downturns. For instance, during the global financial crisis of 2008-2009, when the stock market experienced significant declines, Berkshire Hathaway, led by Warren Buffett, took advantage of the situation and invested billions of dollars in distressed companies such as Goldman Sachs and Bank of America. This demonstrated the value of having cash on hand to capitalize on opportunities during market downturns. Mistake 7. Overemphasis on short-term price movements. Focusing excessively on short-term price fluctuations can cloud judgment. Investors may be tempted to make impulsive decisions based on daily market movements. For example, an investor might panic and sell their shares when the market experiences a temporary downturn, without considering the company's long-term prospects or underlying value. Buffett advises investors to focus on the intrinsic value of investments and not get swayed by short-term market noise. An example of this is seen during the COVID-19 pandemic in 2020, when many investors panicked and sold their investments at a loss, fearing further drops. However, those who remained focused on the long-term prospects of quality companies were rewarded when the market recovered and stock prices rebounded. Mistake 8. Lack of diversification. Failing to diversify is a common mistake that leaves investors vulnerable to concentrated risks. Investing solely in one or a few stocks can result in significant losses if any of those companies face difficulties. A diversified portfolio helps spread the risk across different assets and sectors. For instance, in the late 1990s, during the dot-com bubble, many investors concentrated their portfolios heavily in technology stocks. When the bubble burst in the early 2000s, the technology-heavy portfolios suffered significant losses. Diversification across various sectors could have mitigated the impact of this downturn. Mistake 9. Emotional decision-making. Investors often let emotions such as fear and greed drive their decision-making. Emotionally driven decisions can lead to irrational behavior and poor investment choices. For example, during periods of extreme market euphoria, such as the late stages of a bull market, some investors poured their money into companies with astronomical valuations but little or no profits, driven by the fear of missing out on potential gains. When the bubble burst, these investments proved to be highly speculative and led to substantial losses. Buffett advises investors to maintain a rational and disciplined approach to investing, avoiding impulsive decisions based on emotions. Mistake 10. Not learning from past mistakes. Learning from both successes and failures is crucial for investors. Reflecting on past investment decisions helps refine strategies and avoid repeating the same mistakes. For example, following the financial crisis of 2008, many investors failed to learn from the mistakes of excessive risk-taking and lack of due diligence. In the years that followed, some investors repeated similar mistakes by investing heavily in complex mortgage-backed securities without fully understanding the underlying risks, resulting in losses during subsequent market corrections. Buffett encourages investors to analyze their past investment decisions, understand the reasons behind successes and failures, and apply those lessons to improve future investment choices. By being aware of these common mistakes and learning from real examples, investors can strive to avoid them and improve their investment approach. Warren Buffett's insights remind us of the importance of patience, independent thinking, and long-term focus. Through disciplined investing, thorough research, and continuous learning, investors can increase their chances of achieving long-term success in the market. If you found this video valuable and crave further knowledge about personal finance or investing, we have something special for you. Simply click on the description below to access a link that will take you to 2 of our ebooks, providing an even deeper understanding of the world of investing. We genuinely hope you enjoyed this video and eagerly anticipate your return for future content. Thank you for joining us.